So obviously a pretty successful career
Hmm.
over the 18 years. Um, you obviously traded through a number of cycles, which is which is not common, I guess, these days. Um, those cycles are really important, I think, in terms of picking up overall experience and obviously the products that you were exposed to as well during the
Hmm.
time. Give us an insight as to what you believe now with hindsight was for you the most interesting cycle to trade.
Undoubtedly, the global financial crisis. So, just to rewind a little bit, I mean, my career started in '92, finished in 2010. So that takes in the Fed shock in '94 when the Fed raised interest rates unexpectedly, spooked the markets. Um, Even though we were running an event-driven portfolio, that still had a marked effect on our performance. And actually, we had a bad year that year. We broke even. Um, then the obvious next development is the whole sort of technology bubble and
Mm,
explosion. Um, so it's interesting that you've identified cycles because there are obviously there is the business cycle and there are definitely elements of each cycle which are similar. However, if you think about the two that I've just named, they're quite different
mm,
types of event. And then you've got the bear market that resulted from the implosion of the tech bubble,
mm,
which effectively went on for 3 years, maybe a bit longer actually, 3.5 years. And then another bull market,
mm,
and then leading up to the great financial crisis of
mm,
which started in 2007.
mm,
And so the short answer to your question is the global financial crisis, but there are also some other really large events during my career which I've been fortunate enough to um, to be participating in the markets at that
mm,
time, because you learn something different from each one of those
mm,
crises. And the crises, they're of different magnitudes as well, and obviously they affect um, different parts of economies and different parts of the market. Obviously, the big element with the global financial crisis was it affected everybody, and it was the first time in literally decades and decades that the global financial system was actually in grave danger.
mm,
So in that respect, both an incredible experience, but also actually when we were right in the guts of it, in the depths of it,
mm,
fairly scary as well from certain aspects. So actually, in that during that period, so in fact, when our dear old bank Lehman's went under,
mm,
I was actually, although I was running an equity long short portfolio, I was part of what was known as Credit Products Group at Toronto Dominion.
mm,
And for those people who don't know what those words mean, credit is it is the debt side of the market, and historically, what banks do is they separate the equities division from the debt division. Now, I was actually running an equity portfolio within a credit group, um, which meant that actually, first of all, we had great intelligence in terms of the positions that we were able to take in equities ahead of the rest of the equity market. So, for example, I got short the banks very early on,
mm,
particularly the Australian banks on a valuation basis. And in fact, we went too early, and so we actually were losing money on our bank short for the last part of 2007 because we were doing that on the basis of our analysis of the banks from an equity perspective, but
mm,
also on the basis of what we were seeing going on in the credit world via the desk that we were
mm,
sat on and via the part of the business that we were inhabiting.
mm,
So that gave us a heads up in terms of, we actually were making money when other people were getting carried out, basically.
mm,
Um, but the scary aspect was because we were part of a credit group, the credit guys were not doing well at all. They were basically stuck in enormous positions,
mm,
which became totally illiquid that they basically couldn't get out of. And you just watched their P&L gapping down on a day by day basis. And
mm,
it just, at one stage, in the sort of um, in the post-Lehman period, it just seemed that some of these losses that they were taking just would never be stemmed. They would just never stop. Of course they did, but in the meantime, doing a great deal of wreckage to the business. And so, as an equity participant, watching that unfold was both incredibly fascinating, but also, when you realise the implications, and you've got people queuing outside Northern Rock just down the road on Moorgate, which of course, because that's in the city, and that's where Toronto Dominion is. They're opposite Bloomberg. That's something that's not happened in my lifetime. I'm 43 years old. That's something that you would have seen in the 1930s. Certainly, you don't expect to see that in the 21st century. On a London street, people actually queuing to take their deposits out of Northern Rock. Exceptional. So, by far that particular, it's not really one event. It's sort of that course of events was really the most enlightening and interesting from a trading perspective. It's also we still haven't we haven't actually shrugged off that period. We're still, that story hasn't finished yet. We're still waiting to see what is going to happen. For example, later on in the year when the Fed starts raising rates, there's still a lot of uncertainty over how this whole thing is going to unwind. So you could argue that we're still in that, we're in that post-GFC world, which is still incredibly fascinating and with a lot of uncertainty. Apart from one thing that we can say is that you probably want to be long volatility.